Hello and welcome to the Higher Expectations podcast with the Higher Advantage Real Estate. Well, you'll hear from Ron, Josh, and Michael, a multi-generational family of real estate experts in Southern California. We'll uncover valuable gems and insights on how you can grow your wealth and live a better life, and hopefully send a little bit of positivity and motivation along the way. I'm your host, Ron Higher, and it's my special guest, Michael Mulkey. Thank you for coming on.
Hey, thank you for having me, Ron.
Good to see you. We talk a lot on the phone and rarely get to see each other in person, but thank you for making the drive. How was that drive this morning?
It was good. It was good from the valley up to the Antelope Valley.
Oh, that's good. Yeah, until we get off the freeway, and they're doing some major construction on the road right in front of us out here. And the other day I was coming in, I couldn't even turn left into my own driveway. I had to go down a quarter mile and turn around and go back, and it's like, oh my gosh. And this morning when I came in, I actually remembered before I crossed the freeway to get on the freeway, go down, come back around. It's like nothing that anybody else has to do. It's just like one of these days they're going to fix the street on M4 and 10th Street West, because we got a gigantic Trader Joe's manufacturing and distribution center across the street. So that's what that is. Which is good for the valley, right? It's good for the valley. Got good jobs, and it's just awesome to see the communities bringing, businesses up here like that.
Absolutely.
So, a little bit of background on Michael Mulkey. If you want to talk a little bit about your family, what do you got going on?
Sure. Well, thank you again for having me. I mean, we've known each other for a while, and it's really nice to be up here with you and Michael doing this. So I do appreciate it.
Thank you.
So I'm married. I've been married for 10 years. I have 2 boys, 3 and 10 months old.
Wow, that's good.
So we've got our hands full.
Your hands full for sure.
They're a tremendous blessing.
Yes, they are. That's good.
So that's what I mean. Mainly outside of work, we're raising kids.
Yeah.
I mean, raising our 2 sons. It's been cool. The 3-year-old just started preschool back in August.
Wow.
So that was a transition.
Yeah.
And I enjoy. I'm fairly athletic. I wrestled in high school and college, and played baseball most of my life. And so I, fairly active as far as that, but mainly raising our 2 sons.
That's good. And keep doing that. I know it's difficult with work and everything, but you make family the priority. I mean, you just can't go wrong there, because I believe kids need the parenting, and it's good that you're involved with the kids. So just stay on top of that. We've done that for all. I've got 3 kids. They're all grown now, but I spent a lot of time with them, even while I was working before with the grocery stores, the restaurants, and real estate. So you can make time for it. You can make it work.
Absolutely. I mean, real estate, the mortgage business requires a lot of hours typically, but we do get to always have dinner together, which I'm really grateful for. I think it's important to be at the dinner table together. I think that, it's important for the man to be present.
Yes.
And they look and see, even though they're so young, they are seeing what I do.
That's for sure.
They might not necessarily understand it all, but I think the way we behave and the example that we set is so important.
Absolutely. That is excellent. So, well, very good. So you're in the mortgage business.
Yeah.
And you've been in it for a while. How did you get started?
My best friend, one of my best friends, we know each other since we were 4.
Wow.
Our families went to, I'm from Marietta, Georgia, which is a suburb of Atlanta. And our parents went to high school together. Wow. So, known him my whole life. When I got out of college, he said, you got to come check out where I work. So it was a group of about 25 guys. It was a mortgage broker and a bunch of young guys, most of them under 30. And it was really similar to being on a sports team. And he said, you're going to love the environment, and we help people. Yeah. So come check it out. So I did, and, the rest is kind of history. I mean, it was, he was right. I trusted him.
That's good.
Anything he said, I trusted him because we're like family. So if he said it was good, I was going to try.
That's good. So you started your mortgage career in Georgia?
I did.
Okay.
2001.
Okay. And then you transitioned to California?
2007.
2007.
Yep.
That was just before?
Just before the crash. Yep.
I was going just before that mortgage meltdown? Yeah, because I've been in the real estate for 30 years and seen a few, and it's like I always kind of get an idea of where people are in their business. And so I don't want to tell them stuff that they already know. You know what I mean? So you already went through the
Yeah.
crash and stuff. It's like, oh, that was crazy.
It was crazy.
And you made it through. That was awesome.
I did. Yeah, I did. I was out for a time and came back.
Uh-huh.
But wow, it was a big change. And some important things needed to happen.
That's true.
The Dodd-Frank Act and all that was very good. And I think now we're in a place that, it's a healthy place, I think.
I agree.
For our industry.
I agree. So there was some types of loans that are more popular, I can say, for the general public than others, like FHA, VA, and conventional. What do you do more of, or is it a mixed bag?
Well, it's a good question. 70% of my business is conventional VA, FHA. Don't do much USDA.
Okay.
And about 30% of my business is what we call non-QM.
Okay.
I work with a lot of investors.
And the QM stands for?
Qualified mortgage.
Yes.
So there's a lot of acronyms in the mortgage business. So I'll try.
That's okay. So I understand, but I know that some of the people who what's a QM, because I didn't know what they were a long time ago. What's a QM? Is a non-qualified mortgage. Means they don't fit the criteria for conventional FHA or VA.
Correct. And they also don't have to adhere to some of the guidelines. So like as an example, on the investor side, some of them are treated almost as a commercial transaction. So they may not be under TRID, which is...
TRID stands for?
I don't...
It's okay.
But
it is part of the Dodd-Frank
It's
thing,
part of the
right?
Dodd-Frank Act. And what it is a Truth in Lending Act.
Yeah.
So what it is it is there to protect consumers.
Yeah.
And it's really for primary residences and second homes. Investors is so some of the non-QM loans are almost like a commercial loan, and it's looked at as a business purpose loan.
Okay.
So it's just governed a little differently.
Right.
But so I do about 70%. You could call it vanilla if you want to, although within it, there's a lot of, variables, nuance, especially when it comes to self-employed and things like that. But about 70%. And a lot of it's first-time home buyer. Some move up right now, but mostly in that 70%, mostly first-time home buyer. And then in the 30%, it's mostly investor, whether it be residential, that's 1 to 4 units, or commercial, 5 and up, apartments, things like that. I do some ground up, not a ton, but some. I can do apartments. I can do single families or multifamilies.
When you say ground up, you're talking about like brand new construction, right? Somebody bought a lot and they wanted to build a house on it. You can do the loan for the whole thing.
Correct. Ground up construction from the, dirt up. I've got one going right now, like in Ladera Heights, close to SoFi. They're knocking down a 10-unit apartment building and they're building a new one. So that's an example of a ground up. I have one going in Dallas, Fort Worth area that is like a large luxury home.
Okay.
But it's a single family house.
Okay.
So both ground up, just different property type.
Yeah, that's a good a variety of the amount of different types of loans that you can do, which is really nice.
It is. It's a blessing at Nexa. I can do a lot of different things. So I'm thankful for that.
That's good. On the non-QM loan, are they 30-year fixed, or they got different shorter terms? I've seen some of the commercial loans. Really, I'm asking. Some of the commercial loans I've seen out there are like 5 or 7 years, and then they get refied or something resold or different things like that.
Excuse me. That's a great question. Most you can do 15, you can do 30. These non-QM loans are more similar to a residential loan than a straight commercial loan. I can do a straight commercial loan, and I do some of those. And you're right, a lot of them are like fixed for 5, fixed for 7, fixed for 10, and then they're adjustable, or there's even balloon notes on those. Not as common, but they are out there. The non-QM, standard non-QM, let's say, usually is a residential property, 1 to 4 units.
Okay.
And usually they're 30-year fixed. Now you can do interest only on them though, which is different than conventional FHA or VA. No interest only there. You on a jumbo loan, which we'll call part of that 70%.
Okay.
That's a loan balance, not a purchase price, but a loan balance above 1.2 and change. It's about to change right now, 1.250 million.
Right. So those thresholds for those loans are they change for different counties, right?
They do.
Because I know L.A. County's pretty high, Orange County's pretty high,
Yes.
Ventura's up there. But not far from us, we have Kern County, and really it's only a couple miles up the road here.
852.
And it's like half.
It
not
is.
half, but
Yeah.
it's like, what is it?
800,000, 848, 57, yeah, 800,000 and
Yeah.
change.
And then Kern County is huge because Roseman is in the Antelope Valley. And then they have the Bakersfield and everything else that's, part of Kern County out there. And I get to call it more rural. But I was thinking that the average sales price of a home, I don't know how they calculate all of their numbers, but I knew that the LA's what? The LA County is like 1.2?
San Fernando Valley, I do know, the average sales price for a single family house, and a realtor probably knows this better than I do, but it was $1 million, and that was about 9 months ago for a single family house.
Yeah, that's crazy, right?
I don't know about if you factor in condos.
I was a first-time buyer.
No. It's different. You know what when it is, I'm in 5 states.
Oh.
And every market is different.
Mm-hmm.
The Southern California market, when you're talking about affordability, is definitely one of the most challenging. But once you're in, it's also one of the most rewarding.
Yeah.
Because it's very steady, and on a larger amount, the appreciation is going to grow at a greater number.
Yeah.
So, yes, it is a bigger challenge, but also the reward on the other side is bigger as well. But real quick, I want to piggyback on the way they do the way they figure out high balance, the loan amounts, Fannie Mae, Freddie Mac, the way they set those, it's actually the FHFA, which is a government agency. But the way they set those is also income limits and sales income amounts, like a high balance county.
Mm-hmm.
Typically people make more in that particular county per capita, and the sales prices are higher.
Yeah.
So the rationale behind it is, they want to kind of make it a level playing field based on the demographics.
Right.
That's the reason that they do it.
No, I think it's good.
Yeah.
I just know that it's different in every county.
Absolutely.
Which is kind of not crazy, but it's pretty interesting. We'll say that for sure.
There's the benchmark, which is across all counties in the U.S., and that's 800 and change. And then if you're a high balance county, it can go up to a few different numbers.
Okay.
That's how they do it.
Oh, very good.
Yep.
Very good. Now, there's earlier we were talking about acronyms. There's some other words in the business, the industry, that are not necessarily confusing, but they're kind of overlapping, and they kind of sort of mean the same thing, but they don't exactly mean the same thing, and I'm going to get to that. We have a word called a pre-qualification. There's a pre-approval.
Yes.
And then there's totally underwritten. It's like, can you get into that a little bit about what that means?
I can.
Yeah.
And I know for the first-time home buyers, that can be a little confusing.
Yeah.
In our market, all markets are a little different. Like I mentioned, I work in 5 states.
Mm-hmm.
I do a lot of business in L.A. County and the surrounding, and DFW, Dallas-Fort Worth.
Okay.
But I'm also in Washington, Idaho, and Georgia.
Okay.
In L.A. and the surrounding counties, a listing agent is going to expect a pre-approval.
Yeah.
At minimum.
Right.
A pre-qualification is not what they're looking for.
Yeah.
A pre-approval means that the borrower or the buyer has done an application, an online application, pulled a credit report, and submitted their documents. Yeah. So it's been run through the automated underwriting system, either DU or LP, Fannie Mae, Freddie Mac, right. FHA.
So DU is a program that stands for Desktop Underwriter. So it's like the precursor to the underwriter, the real person.
It's an automated underwriting system.
Automated underwriter. Yeah.
But the truth is, it's only as good as the person who enters the information.
Yeah.
So the information has to be accurate in order for it to give you a good judgment of the file. Mm-hmm. But a pre-approval is as tight of an approval as you can get before you go into underwriting.
Yes.
So that means we've got all the documents, we've gone through everything. If there's something unusual about their income, like maybe they get a lot of overtime or bonus, we might need a verification of employment, meaning we send a document to the employer. And you got your base pay. Yep. But then if we're needing extra income and you do a lot of overtime and things, or commission or bonuses, we need a 2-year history of that. So in this example, we would have gotten all that information up front, and and put it into the system.
Mm-hmm.
We've got the documents, we've got the credit, we've got the application, we run it, you're approved, pre-approval.
Mm-hmm.
Pre-qualification, maybe you've done an application. You might have done a soft credit pull or not. You might have given a verbal
Mm-hmm.
on your income and your assets. That's more of a pre-qualification. And though good, it gives you an idea of where you're at. Things could change a lot once those documents come in. So I actually don't do
I was
pre-qualifications
going
in
to say,
California.
from a realtor's standpoint, whether you're representing a buyer or a seller, on a pre-qualification is the minimum. If just because if they haven't actually gone through the application process and have it through a desktop underwriter, then that's just a crapshoot about if they can actually qualify, because it's a lot of the stuff is verbal on a pre-qualification as opposed to pre-approval. That's what I've understood for the longest time.
That's accurate. The way I look at it is, when you're going to buy a home,
Mm-hmm.
it's a major life decision.
Yeah.
There's a lot, typically, not always, but often, there is a lot of fear, anxiety, uncertainty, excitement around it for the family. I think, I want to best serve them by giving them the most concrete answers I can give them as soon as possible, because it's going to allow you to make the best decisions possible for your future.
Mm-hmm.
There's really no sense in shopping for something that you can't afford,
Yep.
or maybe you can afford more than you thought. So having an idea as concretely as possible, I think, really provides the most value and the most security. Because I look at it like a loan. A lot of what I do is it's about providing security, for people, and in helping a family improve their future. That's kind of what I look at. I do loans, but I feel like I help people improve their future, whether it be a first-time home buyer or an investor. Because a house is, you walk up to it, you look at it, it is a place to live. That's true. But it's also an investment.
Right.
And like I grew up blue collar, my dad, working class family, he painted houses. And there was, not a lot of investments to pass down.
Yeah.
It's the house.
Yeah.
And I think a lot of people feel the same way. They walk up to that house and they look at it and they go, this is my kid's future, one day. And yes, we're going to live here, but, it's a safe investment. And so I say all that to say, I say try to remove as many of the question marks as possible. And I think it's only good for the borrower and good for the realtor, good for everybody, the seller.
It is. I agree 100%. Also, from, like I said, the real estate side, the pre-approval is so much stronger than a pre-qualification. And if you're up against competition, say there's a house that is, smoking hot. It has everything that you want, and it might have everything other people want too. And if you've got competition, you're going to want that pre-approval letter as opposed to pre-qualification letter, because that's what the agent and the homeowners are going to look at. What's the strength of the offer, not just the price and the value of the offer.
Right.
The strength of the borrower is huge and getting into the home sold. Now, if you're doing a refi or doing something like that, that's not going to apply. But if you're out there shopping for a home on the general public, that's what you're up against. And still, it's still a little bit of a seller's market. Has leveled off a little bit since a couple of years ago. It was just nuts out there, right? When the prices were going through the roof. And there was only out here 300 homes for sale at any one particular time. They're coming on and coming off so fast. And right now, there are about 1,100 homes for sale in the Greater Antelope Valley Association of Realtors, MLS. So you have some choices, but it's the same thing. If the house is smoking hot, there's going to be more than one person looking at that house in this market. So having your ducks in a row, so to speak, and having a pre-approval letter is huge. So very good. Yes.
Can I
absolutely.
piggyback on that?
Yeah.
A couple of other things that, if you're a first-time buyer or anyone looking to buy right now, something else I think you can keep in mind, and you can talk to your mortgage professional about it. You want to put your best foot forward. So yes, pre-approval, 100%. Also, talk to your lender about cutting the term, shortening the timeline. How quick can we close? How can we position our financing? because I look at it like the realtor is the quarterback of the transaction. I'm an important part, but I'm not the only part. I'm a receiver or a running back, but because there's a lot more going on than just the loan.
Right.
We kind of deal with the loan on the first half, roughly, and then there's other things to be dealt with. But I want to always position that financing piece to be as strong as possible. So what I would recommend is, especially if you have a very vanilla loan, if you're a W-2 employee, salary, not a whole lot of questions about what you make and things. If you're not self-employed, you can probably close faster. So talk to your lender about, hey, do we have to have a 30-day escrow? Can we get it done in 19 days? Can we remove the loan contingency in 10 days, and appraisal and things like that? Because it just makes your offer stand out. And when you're going up against other people, what makes you different? And then lastly, if the realtor is comfortable with it, your buyer's agent, if they're comfortable with it, I always try to call the listing agent when we make the offer.
Yeah.
And because at the end of the day, with as much technology as we have, it's still about people.
Yeah.
And I always introduce myself. I try to call like as soon as it hits the email. A lot of times I'm CC'd on the offer.
Yeah.
Introduce myself. If are there any questions you have about our financing? I talk about our strong suits and say, your seller, do you have any questions? I will call you every Tuesday, keep you updated. Oh, that's great. And let them know, hey, if you talk to your seller and you think of anything or if they have anything, please call me. And a lot of them have really said, your offer was the same as somebody else, and we weren't sure who to go with. But I got a better feeling about our conversation. Yeah. So I think little things like that can really make a difference, especially in the entry-level price point, because those are the most competitive.
Yes. No, I agree, because in the real estate world side, when you're comparing different loans and different players, right? Because there's lots of players in every transaction. If you can't get a hold of the buyer's lender on a listing agent side, that is no fun.
I bet.
And when you introduce yourself up front, they already know that you just called them. They've got your number and reaching out to you to get questions answered. Like, hey, where are we at in the transaction? Are you able to release down the road the CD, right? The closing disclosure for the buyer, which is the precursor to the loan documents. All this stuff, you can't, I don't know, we're just talking, we're asking for it, we're not getting it because we don't have a qualified person on the other end, which you do, which is really nice.
And I think, yes, it's also just respect, I think. Well, thank you. I think it's just a level of respect for everybody involved, because as a listing agent, you've got a seller that you have to communicate with,
absolutely,
who I'm sure is wanting information. And at the end of the day, really everybody's involved. We're involved in the transaction to serve the buyer and the seller.
Yeah.
That's the big picture of it all.
Right.
The two realtors and the lender, we're really there to serve the buyer and the seller, and anything we can do to make it smooth and easy on them, I think is the right thing to do.
And the open communication, you were looking at some of the stuff on our walls in here, and I wrote a bunch of things down here. One of them is like communication solves almost every problem.
Absolutely.
And it really does. And the lack of communication creates problems.
Even if it's not great news, because nothing's perfect.
Yeah.
I think dealing with it as soon as you know.
Yeah.
It really, people appreciate it. I think people can appreciate that things do sometimes happen, rarely. And if you're just honest and upfront and say, hey, here's what's going on. Here's the solution that we're going to attack right now. I think this is going to work, but I just want to let you know this is what's going on. And I'll follow up with you and let you know what happens.
And that's good, because the open communication, you also get more options, right? Because somebody else, you don't know what everybody else is thinking.
That's right.
And if you open up that conversation and said, this is what's going on right now, this is what my plan of attack is, and say, hey, that's really good. How about this too? I'm going to throw this thing in there, whatever it is.
Absolutely.
And you're going to add that to solving the problem. This is right, getting it closed so that the buyer and seller can move on.
That's right.
Yeah. Very good. Very good. So you've gotten many refis lately. Some of the interest rates have come down a little bit. So I was thinking that maybe you've got a little few refis going on.
We have.
Refi, sorry.
Refinance. Yes, we have been doing some refinances, acronyms. It's not an acronym, but a short.
It's short.
We have been doing a fair amount of them, and I pause because I'm thinking how rates have been coming down really for about 10 weeks,
Yeah.
something like that. And so I've been doing refis starting late September through now. And we'll probably eventually get to this question, but I think if you're a buyer or if you're a homeowner, you really want to pay attention to the timing right now.
Right now.
Excuse me.
Yeah.
Because there's a lot of things going on around interest rates and the overall financial environment that can affect rates. But yes, we have been doing refis, locking them timely. We got a few people locked last week at 5.599 right after the Fed announcement. But we have been doing a fair amount of them, and HELOCs actually too.
And then the HELOC is a home equity line of credit. But what would somebody do with a HELOC?
A lot of different things, and as I mentioned, I work with a lot of investors as well. And as an investor, and some of my investors taught me this, the number one thing they're looking for is leverage as an investor. So I can do the home equity lines of credit on primary residences, second homes, and investment properties. And I have an AI underwritten home equity line of credit that a borrower client can close in as little as 5 days.
Wow.
And they get the money in 10 days. So fast,
That's
in comparison to what a normal process would be. No appraisal, and it's a soft credit pull to start.
Wow.
So very little upfront risk. You get the money quickly. The rates are smoking competitive as far as doing just the same, just doing a normal process. Doing a lot for additions, upgrades. This is primary residence. Additions, upgrades, adding ADUs to investment properties, increasing the value, increasing your cash flow, using the bank's money to work for you. And I think it makes a lot of sense depending on if it pencils out.
Yeah.
The key is, do the numbers work? And if the numbers work, I think it does make a lot of sense. For a lot of investors, adding an ADU or something like that is a good way to go. Consolidating debt, you could do.
Yeah.
It's a second mortgage.
Yeah.
So we want to make sure everyone understands that.
Now that makes sense. I did hear something not too long ago. Somebody had some credit cards that were at 20, 21, 25%. And that's just eating away your net worth.
Yes.
But if you did a refi or a HELOC, pulled some cash out, and your interest rate was at, 5, 6, 7, 8, doesn't matter. If it's not 20, it's a whole lot better. You can pay those off. That makes sense.
It does. And a lot of times, I've got clients that have 3%. They've got 2.75. They've got 4% on $600,000 or $700,000 first. And they call me, and maybe I'm doing a second right now for a family. They're adding the mother of the husband her health has changed. So they don't really want to do a facility. They want her to live with them. So they're adding an ADU. It's a mother-in-law suite, however you want to phrase it. But they're getting $200,000 to do that with. Great rate on the first.
Yeah. Doesn't
really make sense to change to pull that cash. So you want to keep, how does the math work?
Right.
And that's my job.
Yeah.
My job is to say, okay, well, let's look at it. Let's look at some options. We certainly, we could do a refinance, but does that really benefit you ultimately? And maybe we look at a couple of different options. And oftentimes the home equity line of credit is the best option, dependent on future plans. And, we go through the questioning process. True. So as long as it makes sense.
Getting back to the, purchasing on the, whether it's a first time homeowner or a move up or whatever, I say now is a good time to buy. The interest rates are down. If they go down some more, you can refinance. But with that, is there like a formula that says how long you stay in your house? There's a fee for refinancing, but to get the lower rate, if you got a lower monthly payment, that part makes sense. But not if you're only going to stay there for like a year. Right. So you probably have a formula for that, or is a ballpark in. If the numbers make sense, it makes sense for the homeowner, and you go over that with them as well.
I do. The break-even point.
Yeah.
Where is the break-even point? How long do you? And someone taught me this 2 or 3 years ago. I used to ask, how long are you going to be in the home? It's not really the best question.
Yeah.
How long are you going to be in this loan?
Yeah, right.
because adjustable rates are now available and have been available, but they're in fashion again.
Yeah.
Also, fixed for 5, fixed for 7, fixed for 10 doesn't usually make sense. It's about the same as a 30, but fixed for 5, fixed for 7, I'm doing more of those.
Okay.
Now, those are for someone typically who is a little more on top of the financial markets, I would say. It's not for someone who's like a set it and forget it type of person, you know, but I think for the right person, those are great, you know, could be great loans. So the break-even point is what we're looking for on a refinance.
Yeah.
And again, I always ask, you know, a lot of questions on the upfront on our initial conversation because I want to find out, number one, if you're buying a house, my very first question is, why now? Why are we buying now?
Yeah.
And I want to know, you know, is there a specific need around it or what's the real reason we're doing it? And I want to make sure what's important to them.
Sure.
You know, I need to understand that from the very beginning so that everything, you know, tailors itself to meet that particular goal. We can't always get everything we want, but if there's one particular need, which typically there is, we want to make sure we hit that need. So in a refinance, you know, if you're moving soon and things like that, might not make sense. If it's a no-cost refi, might make sense.
Right.
But I think we look at it, and I always try to give people more than one option
That's good.
and let them tell me, you know, because it's their loan, not mine, for them to tell me what works best for them.
Oh, that's excellent. I was thinking, getting back to buying today. We don't have to buy today, right? Some people say, well, I'm going to wait for the interest rates to come down somewhere.
Yeah.
We think they're coming down. They're probably going to come down. But if the rates come down enough to get more buyers off the sidelines, you're going to have a lot more competition when the time comes to purchase a home. So I'm thinking if you can buy now, probably a good idea to buy now. And then if the rates come down later, then you can refi. And then in the same vein, likely the prices are going to come up a little bit, especially in California. Projection from Lawrence Yun, he's the chief economist for the National Association of Realtors, projects about a 3 to 5% increase in home prices next year.
Yes.
Likely most of it will be in the spring, like typical. So if you want to wait to get a lower rate, you're going to calculate how much property values are going to go up and then what kind of competition you're going to have come springtime. I think it's going to get busy in the springtime. I really do.
I agree wholeheartedly. I actually was sending some material out to realtor friends that I work with the past couple of days regarding the current market. Last Wednesday, and I don't want to get too deep in the weeds on it, but I think it does help if you're considering buying right now. Last Wednesday, the Fed cut the Fed funds rate by a quarter, but there's a press conference after, and there can always be fireworks. And so the Fed funds rate is not mortgage interest rates.
That's
so
right.
It's important for us to cover that here.
It is.
I think
agree.
that's helpful. So, it's important to understand that the Fed does not directly cut mortgage rates. They cut the Fed funds rate, which is what banks lend each other overnight, institutions. Prime is adjusted off of that. So if the Fed cuts a quarter, prime will be adjusted off a quarter, so it affects home equity lines of credit. Mortgage interest rates are changed and affected by the way mortgage-backed securities are traded. A mortgage-backed security is thousands of our mortgages bundled together and sold like a Treasury bond is. It's a low-risk, low-ish return investment that all of us have in our retirement accounts and things like that. And the mortgage-backed security competes with the 10-year Treasury bond on the open market for buyers or for investors. Whatever's going on with the 10-year bond, the yield on it, if it's going up, mortgage rates will probably go up. If it's going down, mortgage rates will probably go down. So with that being said, Powell had a press conference, as they always do, after. And in that press conference, he read a prepared statement, and he's very careful because people are parsing every single word he says, because investors want forward guidance. Yeah. Mortgage rates had come down ahead of time because it was almost assumed for sure he's going to cut. So that was already priced into mortgage rates. But what he said in the press conference was a December rate cut is not a foregone conclusion, not by a long shot. So he kind of hammered it home. And then, of course, then he took questions. And, boy, immediately those questions were about that. Because in September at the Fed meeting, they said there were probably going to be 2 more cuts.
Yeah.
So they were changing course.
Yeah.
And throughout some of the questioning, basically what he said from it, what I took is he said, the government shut down. We're not getting the Bureau of Labor and Statistics, BLS data. We're not getting GDP data. We're not getting PCE, personal consumption expenditure. We're not getting a lot of these government reports, but we're getting some information.
Mm-hmm.
We're getting the Beige Book. The Beige Book is there's 12 Fed districts. They go out and talk to small business owners, medium business owners. They get a feel for what's going on out there. And I took it to him saying, hey, the job market's not great, but it's not. We don't think it's terrible.
Right.
And we want to see what happens. We cut twice. We want to let it work its way through the economy. So I needed to say all that to say, right after he said that, mortgage rates went up.
It did.
Slightly, although the Fed cut.
Uh-huh.
Mortgage rates have been coming down for 2 months. Now this morning we got an ADP jobs report that was almost double of the expectations. Though still low, it was more than what was expected. Mortgage rates ticked up again slightly.
Right.
So seasonal, my feeling on buying now, and I'm going to get to the point, my feeling on buying now is I think seasonally, winter's a great time to buy, less competition, which is always good. You're more apt to get a good price. You're more apt to get a seller credit. You're more apt to get the home you like, a better choice. Now, there's less on the market, but I think less competition is always good. And rates are lower now. They're hovering around 3-year lows. There's no guarantee they're going to stay low.
Right.
September of 24, they came down to 5.6. Closed refis at 5.6. They went back up to 7%.
Yeah.
So there's no guarantee it's going to stay low. I think, there are things that could happen that could make them go back up again. I'll stop there, but there's one other thing I want to mention, but I'll stop there and I can come back.
So what I was going to say, before Powell made his speech, that 10-year Treasury note, was it like 3.8 or 3.89, something like that?
Yes.
And then after he made his comment, it went up to 4. Then it was 4.1. It went up almost like a quarter of a point or a third of a point over a span of a week. It's like, hey, they just lowered the rates. Well, because that's what Michael just said. The Fed rate cuts does not affect the mortgages. It's basically that 10-year Treasury note. So if you want to see where mortgage rates are going, watch that 10-year Treasury note. They're not lockstep, but it's a good indicator.
It absolutely is. And the yield, if the yield is going up, which is the return, that means the return on the investment. And the thinking is if they're not getting enough buyers, whoever is issuing that bond, if it's a 10-year bond, it's the U.S. government, whoever is issuing that bond, if they're not getting enough investors, they're going to up the return to get more investors, or the yield. So the return has to be greater to get the appetite up.
Yeah.
So that's the rationale. Now, last thing I'll say, I think Powell's last day is May 12th of 26. He's definitely not going to be the Fed chair after that. I would say probably the person coming in, I think it's safe to say they're going to probably cut, or probably wouldn't be appointed. The president appoints the person. So it's his choice who he wants there. I would think they probably would cut, but something to consider if you're buying a home is this. If the person aggressively cuts, rates could go down temporarily. Home prices will certainly go up if rates go down, because it's a supply and demand thing. So if home prices go up, you can never go back and get a better price.
No.
So that's kind of why I like buying now, maybe refinancing. And then secondly, and this is something I don't know and it's impossible to predict, but it's something that I do contemplate. If the person aggressively cuts, inflation is not dead yet. It's still not where the Fed wants it to be.
True.
So it could come back. And if inflation comes back, rates are going to go up
That's
again.
right.
So that's sort of my thinking regarding seasonality, regarding the recent cut, and regarding what might be happening in the spring. Those three things combined, to me, makes now seem like a good time to do it. Those three things I think about when I think about timing.
They're pretty powerful. Timing's huge.
Yep.
That's for sure. Right. One thing I want to touch on that we were started a while back was that the conventional FHA and VA type loans. On an FHA, you're looking at about 3.5% down. Can the seller contribute to any? You have to have X amount of dollars of your own money in that transaction.
The seller can't contribute to the down payment, but he can contribute to a seller credit towards closing costs, and FHA can be up to 6% with a minimum down payment. You can get down payment assistance, which can help, or a grant, which can help with the down payment.
Very good. Do you have any special programs like that? Then like down payment assistance or first-time buyer or credit grants or anything like that?
We do. We have a lot of different down payment assistance programs in California. Some are national. Some are specific. I have a few in Texas, some in Georgia, one in Washington, one in Idaho. So they're all a little different in what they do. Some of them are bond programs. Some are government assistance programs. They're all really good. I like them for different reasons. I would say if you have the money, I think putting a down payment down is going to be better for you long term.
Of your own money.
Yes, because the terms are always any help you get is going to affect the terms in some way. So, when we're talking just the math, I think if you have the money, you're better off doing a minimum down or whatever the case may be, because long term, you're going to be better off. You're going to save more in the long term by doing it. But if you need the help, or if for some reason it doesn't make sense to invest your own money into it, I think they're great programs. I've done a lot of them, and I've got some just amazing, success stories for families and people who is wonderful, feel-good stories, and using down payment assistance.
That's good.
Yeah.
That's good. With the conventional, they have like a 95% loan to value, 90, 80, whatever. But you get down to 80% loan to value, you don't have any more mortgage insurance.
Correct.
So how do they calculate that 95, 90, 85 to 80%? Or is there a formula for that? Do you know?
Yes, I will. So two things.
Yeah.
The minimum down on conventional is actually 3%. I've got a 97.
Okay.
There's income requirements around it. You have to be a first-time homebuyer.
Okay.
But it is I have Fannie Mae and Freddie Mac both, so DU and LP.
Okay. LP is loan processor.
Loan,
DU,
yes.
you already know.
So
Desktop
acronyms,
underwriting.
I'm
It's
sorry.
okay. It's all good. It's all good.
So the calculation is the lower of the two. So loan amount and purchase price or appraised value. The lower of the two, purchase price or appraised value.
Okay.
So whatever the lower of the two come in at, they take that and, the loan amount, and it's 80%. So the loan amount has to be 80%, 90%, 95, 97% of the lower of the two, purchase price or appraised value. Typically, it usually appraises for the purchase price. So I'd say that's 75% of the time. But
Yeah.
so that's the equation.
Very good. So I've got special programs. Talked about the HELOCs. So there's a lot of other stuff to talk about in loans because there are so many. I'm going to talk about a couple of them here today. What other? I have a question for you. Sure. So you got into the loan business a long time ago, mainly to help people. That's why we're in real estate. We like helping people. Do you have a memorable family or a situation where you helped somebody and it just made you feel so good? It's like that's why I'm in this business.
I've got it's interesting. I mean, I do. I have. Thank God, I have a lot of them actually, and if it just feels so good. My wife loves for me to tell these stories at dinner time. She always asks, "What's going on with so and so, and have they closed yet?" And I had a first generation American single mother.
Mm-hmm.
She had been in this country 10 years, maybe, I don't know. I think she had $5,000. She was introduced to me by a realtor friend of mine. She was just thinking, I just don't know. Is it possible at all? I said, let's take a look at it. We got her approved on a down payment assistance loan. Mm-hmm. We structured it so the seller paid the majority of so we knew going in, we're going to have to ask for almost like the max seller concession. But the thing is, if the seller won't agree to it, we can build it back into our offer because the seller just cares if they net the same. Yeah. As long as it appraises. Right. Because we're increasing the purchase price if we do that. And the realtor would be the one handling that, not the mortgage person. But we're all talking as a team, right?
Right.
Myself, the borrower, or the borrower's realtor. We're all talking about the strategy to make it work. So anyway, so we knew we didn't have a lot of money to work with. So we got her approved on down payment assistance. We had it structured, and we knew we were going to ask for X amount of seller credit for closing costs. Her income, we just were squeaking by. I mean, it was like 1/10 of a point from the max there. And single mother, first generation American, got her closed. I think she brought $4,000 to closing.
Wow.
Man, she was so it was wonderful, wonderful, wonderful.
That's great.
I helped a mother too buy her son. She did a home equity line of credit on her condo to buy her son her first home, and I did the loan for him. And when I called to tell her it had finished, she started crying.
Wow.
It was, it's hard to get better than that.
Yeah.
Because she was so happy to have helped her son buy her first house. So it was really cool. There's a lot of stories like that.
Almost everyone's got a good story behind it, about helping somebody move to get closer to their kids, or, like you said, sell a house. I mean, a home equity line of credit to help them buy a home, because that's a difficult time these days. The prices are so high, even from a realtor standpoint. Yeah, we like them high. No, we want them to be affordable. Is what we want them to be.
Yeah.
That's ideal in our business, and we like helping people. So if the rates are too high, or if the properties are too high, we have a hard time helping people. And then we like helping people.
Absolutely.
So I got a couple of fun questions here for you.
Okay.
We call it, it's like a rapid fire, but because we like baseball, I call mine quick pitch.
Okay.
All right.
Let me get ready.
Yeah, right. All right. What's your favorite food?
Cheeseburger.
Oh, cheeseburger. Awesome. Cake or pie?
I'm from the South, so pie.
I like pecan pie?
I love pecan. I love peach. I'm from Georgia.
Peach too. Oh,
peach,
yeah.
pecan.
That's awesome.
And my wife makes a great apple pie.
There you go. Just all of the above. Yeah,
I like
pies. That's good. What's your favorite holiday?
Favorite holiday, boy. Well, I'm a believer, so Easter and Christmas, both I love. It's hard to beat Thanksgiving because there's no present. There's nothing to worry about.
Yeah.
And but probably Easter, I'd say, if I had to pick one. But I like them all.
They're all good.
Yep.
Very good. All right. Mountain, beach, or desert? What would you prefer?
Beach.
Beach is good. Yeah. My mom lives at the beach. I don't know if I told you that or not.
Really?
She grew up here in the Antelope Valley.
Okay.
And then she always wanted to move to the beach. And like 30 years ago, maybe a little bit more, she bought a little place in Carpinteria.
Oh, man, that's beautiful.
Isn't that? We call it
is
Sleepy
beautiful.
Town, but that's the beach there is awesome.
It's beautiful up there.
Yeah, it's very, very calm. And then what's your favorite place to vacation?
We go, and we live in L.A. We go to Ventura a lot, actually, just because it's close. We have 2 small children, so it's not easy with their ages being so young. I'd say a beach. I mean, our life is pretty fast-paced, and this business is pretty fast-paced. It's a 30-day cycle. And so, every morning you're up, you're at it, you're going. And I like that. That fits my God-given personality, so I'm grateful that I get to do that. But I don't like being on the go when I'm on vacation, really. So, a beach somewhere that's not crowded.
Yeah, that's good. We like going to Ventura, too, and it's not that far. So very good, very good. So if somebody wanted to get a hold of you, how would they go about doing that?
Well, sure. They could call me. My phone number is 310-741-7321. That's really the best way. You could email me, but the calling is the best. My email is mmulkey at Nexa, so it's N as in Nancy, EXA, mortgage.com. Those are the best 2 ways to get in touch with me.
We'll put those links and numbers in at the bottom of the podcast, so you won't have to memorize them, but they'll be there for you. And I want to thank you very much for coming on the show. Appreciate that. That was some great information. I love that. That was awesome.
Thank you,
I hope
Ron.
you guys enjoyed that too. And remember, for higher expectations and higher standards, choose the higher advantage, real estate, sales, and service. Take care. Be safe out there, and have a great day.